Start video. Hi, good morning.
Good morning, Aaron. How are you today?
I'm good. How are you doing?
Doing well, thank you.
Good.
I think Shannon's going to be joining in just a few minutes, so we'll
Okay, excellent.
wait for her.
I'll be right back. Give me one moment.
Okay, take your time.
So are you working remote?
I'm sorry, say that again, Aaron?
Are you working remote?
Yes. Almost all of us are from the Badger office. There's usually one or two that go in, but the rest are remote. And it's been working fine. We're able to get work done.
Awesome.
I think it's about time for you to get back to the office, Amanda.
I'm sorry?
I think it's about time for you to get back to the office.
Oh.
Pulling up my notes.
Good morning.
Good morning.
Good morning.
Hi, Jeff.
Good morning. Hey, Shannon.
Yes, sir.
Did we have an ADP call this morning too?
Yes, I was splitting it with Megan, but I wasn't thinking about that I was going to be double booking you too. So Megan and Veronica are taking the ADP call.
Okay, well, they can loop me in if they need me.
Yeah, I mean, I think Rick's on it too, so I feel like they should be fine.
I don't think he's on it this morning.
Oh, okay. Hi, Ed.
Hey Shannon, how you doing?
Great. How are you? I haven't seen you in a while.
It has been a long time. You doing okay?
Yes, sir. Doing
Well, that's
good. I'm going to give everybody just a few more minutes to log in, and then I'll introduce our speakers. And then Aaron, I see you. Is Alan going to be in the same room or calling in separate?
Yeah, he should be in the same room. He's finishing up an executive committee meeting.
All right, we'll give him a minute.
Yeah, please, that would work out great.
Oh, I see Keith. I see the Fletchers. I see Bob. Hi, Greg.
Yeah, I don't want my picture on the screen. It's too ugly.
All good.
Hey, Aaron. Aaron, you listening?
Yes.
By the way, I didn't go to Creosote Springs today.
Oh, okay. I was like, I recognize that voice.
I ended up going to the chiropractor. I ended up getting then I had to go to my pain management doctor, and I ended up with another cortisone shot in my hip. And I guess it got me wired up last night. I couldn't sleep. So there was no way I didn't go to bed till about 12, and I'd had to get up at 3. So, yeah, I just canceled it. We'll do it later. But I just want to let you know that.
Okay. Yeah, I was glad I got to see my chiropractor yesterday. It made a big difference. I'm getting old.
Well, he's now talking about, now he's telling, they looked at another MRI and now they're telling me I need both of my hips replaced.
Oh, really?
Yeah, I'm not doing it.
I'm Joni Mitchell. I'm joining for Dr. Aaron Terry.
Great,
All right,
welcome.
good morning.
We have one more speaker coming with Aaron, and so we're going to wait a minute for Alan, and then we'll get going. Unless Aaron, you want to start without him? What do you think?
I can start and talk a little bit about the bank itself, but Alan will really be the best person to speak to the Main Street program.
Okay, well, let's just give it another minute or two.
Yeah.
In the comments, I'm going to post a fact sheet that's pretty good just for reference, and it's from the Federal Reserve website. Let me know if that link works or not. If not, then here's the Federal Reserve website. You can download it there. But so usually how we do these meetings is if you have specific questions, there's a chat feature at the bottom. So it should look like a bubble and say chat, and then you can post either to everyone or you can use the drop down and you can just send it directly to me, either way. So if there's a question that you have, you can go ahead and type it there, and then I'll ask it just so that we have some kind of rhythm to that. And then I will be recording this video, so if for some reason somebody wasn't able to make it, I'll send it out to the distribution list, anybody that wants to see it. Or if you have follow-up questions after this, feel free to email me directly. You know, actually, Amanda, can you push record? Because I think you're the admin on the meeting.
Yes, it's actually already recording.
Sweet. All right, well, Aaron, why don't you go ahead and share a little bit about the bank, text Alan, kind of get his ETA, and then.
Yeah, that's what I'm doing right now.
Cool. So the purpose of this call is really just to do a high-level overview of the Main Street lending program. And then also just for business owners in general, like what are potential opportunities with it? What does that look like? They have some benefits like payment deferrals for several years and things of that nature. So just want to get kind of educated on it and give people a chance to ask questions. And then we'll go from there. So Aaron, if you want to take a minute, just introduce yourself.
Yeah, my pleasure. Good morning, everybody. I'm Aaron Seaman. I'm Vice President of Business Development for the Bank of San Antonio. We are a business bank that has been established in San Antonio for roughly a little over 13 years now. I think going on 14 years. We were founded by a group of local business leaders and community leaders who just felt like they weren't getting the service that they needed through their existing banking relationships, and also believed in the value and importance of establishing a relationship with their bank. So a group of them came together, led by Bruce Bugg, who's the current chairman of the bank. He's actually chairman of Southwest Bank Shares, which is the holding company for the Bank of San Antonio, the Bank of Austin, and Texas Hill Country Bank. He's also very politically involved, serves as the chairman of the Texas Department of Transportation right now. Very close with the governor, but Bruce pulled together a group of business people with an initial investment of about $28 million, and that was the initial charter for the bank. The bank grew really organically, and the model for the bank's growth was growing through a combination of deposits and treasury management, finding more efficient, effective ways for our clients to conduct their business. And then it was a different model compared to larger banks. Larger banks tend to grow off of fee income. They push for loans, and really the focus here was on deposits. So it proved to be very successful. The Bank of San Antonio is one of the fastest growing de novo banks in the country. And we have grown to add a variety of services for our clients to include a full insurance firm, Bank of San Antonio Insurance Group, which does commercial insurance as well as employee benefits. Our wealth group, which is now branded as Asperian. We have a factoring company. And then just the bank itself. We have our commercial lending side, our business banking side, and the difference between the two. Commercial lending tends to focus on businesses with gross revenues over 10 million, whereas the business banking is under 10 million. So it's more on the small, medium-sized business. Then we also have a private banking group that works with our high net worth clients. We've got about 120 plus investors. And I will say pre-COVID, we were at about 850 million or so in assets. We had looked at hitting the $1 billion mark, I think getting closer to 2021, but thanks to COVID-19 and the PPP program, we hit that about a month ago. So we've been growing very quickly, very steadily, but a very deliberate growth. One of the things that we've tried to do is ensure that we are responding quickly to our clients, especially those that are seeking funding assistance. We are not always able to say yes. We are a very conservative bank, but if it's a no, it's a quick no, and generally it should come along with a direction on how to get to a yes. We don't believe there's any value in stringing somebody along and then letting them know bad news after they've been waiting for so long. So we try to act pretty quickly. And really the foundation of this bank is relationships. We truly believe in establishing a relationship, which Shannon and Keith can attest to. Building a relationship with our clients, growing with them, and really becoming a valued partner to them. So I think we found during the last few months really the value and the importance of having having relationship with your financial institution. We were able, I think we did almost 800 loans, PPP loans. I think in round one with the PPP program, we did as many loans in a 12-day period, almost 500 as we do in a year. So we were working around the clock and still continue working on that program, but really more getting prepared for the forgiveness piece. And, we are glad that the SBA finally released their updated forgiveness applications yesterday, including an easy app, which I'm sure you'll be getting information on if you took out one of these loans. But that will be my primary focus over the next several months.
Did they post that online, the Easy app for the forgiveness loan?
They did. Yeah, it's actually on the SBA's website.
Great.
There's instructions and there's qualifiers on that. And I thought I sent you a link yesterday or forwarded an email.
You might have. I might have not got
from one of our state banking associations, just with some good overview of that program. The good news is they've shortened what was previously an 11-page application to about 3 pages.
And that's for the PPP?
That's for the Easy app for the PPP program.
One question we've had, and I haven't seen it finalized for the final guidance, is it an 8-week election or a 24-week election, or once you go past your 8 weeks, let's say that you've used all your funds by week 10 or 12, can you go ahead and apply at that point in time?
Yes.
Okay.
It was the amendment to change the 8 weeks to 24 weeks was done automatically. So as we've advised our clients, there's no request that needs to be made, no formal, request that needs to be submitted for that. Essentially, everybody's 8 weeks is now turned into 24. With that said, you can apply for forgiveness as soon as you feel like you are ready to do so.
Okay.
And
Well, I'm going to start.
and Alan's just walking into the room right now.
Of the program, and then that'll give Alan a minute to settle, and then
Sure.
So, and I'll be toggling back and forth between my notes. So if I look like I'm so basically, the Federal Reserve established this program, and they're making a $75 billion equity investment into they're calling it a Main Street special purpose vehicle, basically. These are not forgivable loans. So it's important to note this is a traditional loan, is not forgivable. And then there's 3 different facilities. One's called like a MS, and then there's an NLF, PLF, and ELF. And so there's 3 different facilities, and they all have different terms. And if Alan, if you're ready to go, do you want to go ahead and take it from here and just give an overview of the program and the different options? I don't want to throw it at you right when you sat down.
Yeah, no, absolutely. And I apologize, I was running a little late today. So the program has basically 3 options. It has the new Main Street new loan program, the priority loan program, and the expanded loan program. I would anticipate that the majority of individuals who enter the program will do either the new program or the priority program. The terms of the program as per interest rates, fees, amortization, et cetera, are identical. So the real difference between the program is some of the restrictions that it places on you as it pertains to either existing debt or refinance debt. And then also some of the restrictions that it places on your ability to make dividends and distributions. And so you need to be very cognizant of that difference depending on your strategy for paying either yourself as the owner, your partners, shareholders, et cetera. The basic premise is the new Main Street program allows you to lever up 4 times your 2019 EBITDA and allows you to basically use those funds for anything that you so choose. In contrast, the priority loan program allows you to do 6 times EBITDA, 2019 EBITDA, because again, the program was designed to help clients performing well in 19 who saw a dip in 20, who need some time to then stabilize and come out of this recession where they were in 2019. Both programs have a 24-month deferment period. The first 12 months, interest and principal is deferred. And then the secondary 12 months is basically you're making principal payments, but interest is deferred. And then the 3rd year, 4th year, and 5th year, you have amortization of 15%, with a balloon of 70% at the end of the 5th year. The challenge for most banks, to be candid, in this process is how do we model and underwrite that? Because we're asking to be showing 5-year projections. We've talked to some clients who are already using that, Shannon, and trying to put together 5-year projections. But I want to and will continue to visit and update you more on what we're working on, because that's quite a Herculean task, as you can imagine. So we're trying to determine if that's required or preferred from the Federal Reserve, and we're trying to get clarity there.
Now, and that would only be for the expanded, that would be an issue?
No, that's going to be for all
That's
3.
for all of them, they want that.
Right, because the amortization for those 3 programs is identical. So it used to be different, but then they changed it so they're all identical. with a 24-month slightly deferred period, the 15% amortization in year 3, 15% in year 4, and then a large balloon of 70 at the end of the year 5. They all have a 5-year term, and that is non-negotiable. The rate for all the programs is the same. It's the 1-month or 30-month LIBOR rate plus 300 bips. That's non-negotiable. It can't be increased or decreased. Additionally, there are some fees that are going to be expected. The borrower is going to pay 1% of the total amount of the loan up front, collected by the lender, paid straight through to the Treasury Department or the Federal Reserve. Then there is the option, and there is a option for lenders to charge up to an additional 1, and that will basically be in the bank's discretion, and it'll be collected by the banks and kept by the banks. But again, it's their discretion, and those are basically the structures for the rate and the fees. Then additionally, once you basically set that forward, the bank's traditional underwriting criteria are used. So I want to be very clear on this. It's very different than the PPP. Banks are being told, underwrite these loans as you normally would, and then use your covenant structure that you normally would. It can be unsecured, secured, it can be collateralized, non-collateralized, all of those things that we would traditionally do. So PPP, as y'all remember, if you participated, was an unsecured loan guaranteed by the SBA. That's not what this is. So banks are going to be asked to underwrite these loans traditionally and then sell 95% of the participation to the Federal Reserve. The banks will retain 5% of the loan and service the debt. Now, as I indicated at the very beginning, there's 2 different programs, the new and the priority. The new and priority differ on the amount of EBITDA that you can lever, but the other main difference is this. If you're using the new program, you cannot use the funds to refinance any existing debt. It gets carried and married to whatever debt you have at that lending institution and becomes what we call pari passu, meaning it is in the waterfall in bankruptcy equal to whatever existing debt you have at the time. The priority loan program allows you to pay off or refinance under these terms that I discussed existing debt, but you cannot refinance existing debt at the institution that is issuing the Main Street Loan Program. So case in point, and I see Jeff on the phone. So if Jeff's client from Wells Fargo wants to use this program and has $2 million at Wells Fargo, and Wells Fargo wants to give him the loan, they cannot refinance that Wells Fargo debt using the Main Street Loan Program proceeds. But inversely, if Frost Bank wanted to call on Jeff's client, they could use the Main Street Loan Program and roll in the Wells Fargo debt they have, plus whatever else they can lever up using the EBITDA calculation that we mentioned. So it's very specific that the banks issuing these loans cannot use these proceeds to in any way reduce, impact, or pay off their own debt. And as you can think about it logically, that makes a lot of sense since the Federal Reserve is going to be buying 95% of these loans. They don't want banks to use this as a way to de-risk their balance sheets.
So if someone is wanting to maybe use this as a debt restructuring tool, let's say they have, vehicle loans and a line of credit and things like that. So 1, they wouldn't be able to go to their existing bank. And 2, they would have to use the priority loan or the expanded and not the
New.
The new, thank you.
Correct.
To do that.
Correct.
And it would have to be with a different bank than what their other debt is all currently with.
Correct.
And
right.
It's going to follow a normal underwriting process, but they could, in theory, basically use use that loan to pay down other debt and kind of restructure their current debt and then defer payments for 2 years.
Correct. The payments get deferred 2 years, and then you have that accelerated amortization with the balloon at the end. One of the other things that I mentioned at the very beginning was there are restrictions to what and how you can use these proceeds as you pay for your corporate executives, your partners, et cetera, and your shareholders. It specifically defines individuals who in 2019 received total compensation between $450,000 and $3 million. As long as you have any of these Main Street loan programs, you cannot give them any more compensation than they received in 2019, period, end of discussion. If you have 3 million individuals who are making $3 million or more in any form, meaning business income, partnership distributions, salary, et cetera, anybody over 3 million, you can continue to pay them at that $3 million range, plus then 50% of what they made in 2019 over 3 million. So if they made 4 million in 2019, you'd only be able to give them $3.5 million as long as you have a Main Street loan program on an annualized basis. So, and then here's the kicker, just to be very clear, not only does that get enforced while you have the Main Street loan program proceeds, it extends an additional 12 months beyond after you have paid back the proceeds. So for large companies who have executives and partners and large distributions, this may be very, very constricting, and you just need to be aware of that.
Okay. Yeah, most of our clients, I don't think that compensation range will be a huge barrier, but what I'm wondering is about the balloon, you know, in year 5, for example, what flexibility is there on the bank side? I mean, at that point, if they wanted to, you know, get a revolver or a restructured debt with their bank at that point, they could do that in year 4 or 5. Is that correct? Like pay that one off early and then just restructure debt differently? Like what's
Correct.
to keep from doing that?
Yeah,
Okay.
correct. And so what I anticipate inside the challenge right now, and again, as I think what we're trying to struggle with and understand is how banks are going to treat this, and if there's any guidance, is we all know that there's going to be that 70% balloon. And so are we going to be asked as lenders to underwrite to that reality before we seek approval? Or are we going to be given regulatory and supervisory relief to say, well, we're acknowledging that it exists, but we can't see that far into the future, therefore we're not really going to underwrite to it. And so there's the challenge. But what I would anticipate, Shannon, is in some way as we go through this, and it's accelerating pretty quickly on the timeline, and I can speak to that in a second, I anticipate that banks are going to have to discuss that in their underwriting in some form to say, and we anticipate this company is strong enough that in 5 years, if we don't underwrite it, we believe there's access to capital markets that could necessarily take this debt on. Or if it's collateralized by, say, for example, real estate, you know, we could then go to a traditional 10-year amortization cycle, which they could then clearly pay over, say, 10 years, fully amortizing with 2019 EBITDA as a example. But that has to be taken into account. And I anticipate for clients that would be the desire would be that you would keep that and restructure that debt rather than have to pay it off in full. Timeline. Oh, I'm sorry, one second, Shannon, because you mentioned this. I do want to make very clear, there is no restrictions on prepayment penalty on any of these proceeds throughout the program. So if a client, for example, is doing well in 2019, has concerns about where they're ending up because first quarter and second quarter of this year look bad, but let's say they do rebound and restructure and do very well for the rest of the year in 2021, and they then are quote unquote traditionally bankable again, and they want to, they can take these proceeds at any point in time, go to another institution and get them financed in a more traditional way and pay off all of the Main Street loan proceeds. Or if they just generate additional cash flow, they can start paying down principal early at any time without any penalties whatsoever. And that's very clearly stated and must be part of the program. So timeline, the portal for the Main Street Lending Program for lenders opened up Monday of this week. Lenders were instructed that if you are going to participate, you needed to submit your registration to the Federal Reserve as a qualified lender. I can tell you anecdotally, we did on Monday. We were told that it would take about 2 or 3 days to receive confirmation of that registration, and it is Thursday and we're still waiting for a response. So not completely unexpected that it didn't go as smoothly as planned. But that said, I anticipate in the next week or two, they will be ready to actually accept applications through the portal. The other thing to just be cognizant of is there are 2 options that your lenders will have if you are interested in putting forward an application and they want to proceed. They can provide a commitment letter that guarantees that the bank is going to basically pay and do the loan before they receive confirmation of acceptance and participation by the SPV. And then they also have very specific language presented by the Fed that will allow banks to put forward a commitment that says, we will provide this financing to you contingent upon acceptance and participation purchased by the SPV. I would almost be willing to bet the bottom dollar that every bank is going to do that second form of the commitment letter because they do not want their hands tied. And that's because of a variety of capital needs and allocations that they're dealing with, et cetera. So that's what I anticipate most of your clients will see if they go down this road, is a commitment letter saying approval contingent upon acceptance by SPV. The SPV has said that once completed and appropriate loan packages are delivered, they will respond within 3 to 5 business days with their either acceptance or denial of that participation. But again, I don't know where they're going to stand on that exactly today. We haven't tested it yet. So that was really fast and a whole lot of information. But I don't know how you wanted to handle it, Shan, but I'm happy to answer specific questions if individuals have some.
Would you mind just recapping the interest rates and the payment terms again? I had a question.
Sure. So the interest rates are all the same for all 3 programs. They're either the 30 or the 90-day LIBOR rate plus 300 bips or 3%. It is a variable interest rate. It is not something that you can fix through the Main Street Loan Program, though for those of you who are sophisticated enough and are using this this vehicle and tool, questions are being asked if you can take it and get a swap to fix the rate for the life of the loan. I don't anticipate that to be the case just because of the prepayment nature of it, but it is something that people have already asked and we're waiting guidance on. You were going to pay 1% fee up front automatically as a borrower to the Federal Reserve, and then up to another percentage point to your lender. And again, that is in the lender's discretion as far as how much they want to charge you for that additional fee. The repayment terms, it's a 5-year commitment or a 5-year term. Principal and interest is deferred on the first 12 months. And then principal payments are deferred for the next 12 months. It's interest only from month 13 to 24. In the 3rd year, you will be required to amortize and pay down the principal by 15%, with an additional 15% principal reduction in year 4, and the anticipation of a balloon at the end of year 5. Now, let me ask, and this is kind of early, and I don't know how many of you have coffee, but the last time I did the math, 15% in year 3, 15% in year 4 is 30%, and then a balloon is expected at the end of year 5, and that's 70%. So if you do the math, that means that maybe you don't have to pay any principal in year 5 at all. But we're asking for clarification on that as well. I think the intent was to say that a principal balloon of 70% will be required up to 70%. but we don't know what is allowed as far as the amortization in year 5 accordingly. So we're trying to get clarity on that too, Shannon.
That makes sense. And if somebody has more than one business, the loan would follow, I'm assuming, the business EIN. So you would have to apply for each entity, or do you, if it's one owner with multiple businesses, is that one? Like, how would you structure that?
Typically, I think if you're talking about separate EINs that are not in a subsidiary organizational chart in any way, then you would do a separate loan per EIN. The ownership interests really are irrelevant because it is based on the EBITDA of the company. And so if they are filing separate financial statements under different EINs, it'd be separate loans. Now, the minimum loan that you can apply for was reduced. So it's only $250,000. So they tried to make this much more accessible than originally put forward. So in that instance, you may be able to do 4 or 5 small Main Street loan programs to different entities. But what I'm seeing, some of the applications that we're working with right now really are where we're looking at a parent and a group of subsidiaries who have traditionally provided consolidated and consolidating audits and financials. And so what we're utilizing the program to do is give the loan at the parent level and then basically have as additional guarantors and or co-borrowers all of the subsidiaries so that they can take advantage of the consolidated EIN and then use that for the leverage ratio. And so the loan will be to the parent. And there's no restrictions of setting that format up because, again, that's not any different than what we would do in a traditional underwriting sense.
I was trying to think about what the advantage would be. You know, for a lot of our clients, they might have some various small loans on their books, or just kind of loans and line of credit they've taken out over time, where they have, you know, vehicles and equipment, and you know. Do you see this as being a good one? You can consolidate your notes under one loan, but then 2, you can defer principal payments, so it'll help your cash flow over the next couple of years. For me, really, the downside is just being ready for that year 5, because you're just going to get hammered if you're not planning accordingly. But you know, at that point in time, let's say a client is coming around year 4 and they are bankable, like it doesn't sound like there's restrictions on the bank to be able to structure a different loan or almost refinance in a way that Main Street loan, correct?
Correct, right. And there are no restrictions at all at that point. And so to be very clear, once the Main Street lending program is put in place, and again, the guidance from the Federal Reserve is very clear, and as you said, is the desire was to get capital out to the markets to ensure that the banks who are struggling have options. And if you as a business have to certify one of 2 things, one, that you have had negative impact due to COVID-19, and you're certifying 2, that your capital markets access was not as good as it was before COVID-19. Now, I know those are very general statements, but I would argue that pretty much everybody's been affected in some way negatively by COVID-19. And I would probably argue that it's pretty easy to show and certify that the terms that you have been offered lately by your institution are not the same as they were in, say, December of 2019. But you do need to certify those. And of course, as a good, my lawyer in the back room would say, please make sure all clients know that we would encourage them to have their legal staff review those certifications before signing.
Well, and they had the safe harbor, for example, for the PPP loan. They did that kind of $2 million safe harbor. Have you heard anything about a safe harbor for this?
No, and I anticipate
smaller businesses. Okay.
Yeah, and I anticipate they won't, only because, again, they're still utilizing and asking us to use traditional underwriting standards, and they are putting the onus on the banks ultimately to basically take that liability, since we're retaining part of the loan. And so I just don't think that the rules in that sense are going to be the same. Now, it is clearly different than PPP because
Yeah, I mean, it's not forgivable. So from their perspective, it's like
exactly
you're getting it paid back. So the risk there, I wouldn't think is high. I don't think they are going to come back. This is just I don't think they're going to come back and have you prove with some, analysis or something. Highly doubtful. But I would make sure that you have some documentation before you certify that.
Yeah.
So I guess like the risk I would say is, in my mind, is somebody basically refinancing and consolidating and then not being able to restructure that 4 years from now.
Correct. And again, remembering that you have the ability to maybe stretch a little bit more than you normally would, right? I mean, traditional standards, most banks in a traditional format don't get comfortable allowing a company to lever up 6 times. And that's just pretty traditional. So, there is the risk of over levering and then not being able to unwind because your cash flow and your revenue streams don't stabilize or don't get back to 2019 levels, which again, we don't know where that's going to take us 3-4 years from now. And so therein is the risk, is that you may find yourself after, say, year 4, still sitting at 5 times leverage. And that, I would argue, may be a little bit difficult to go then to the markets, even if they have normalized, and get that refunded or refinanced in a traditional sense. So it is available to go that high, but it's not necessarily advisable.
Yeah, that makes sense. And then from like a bank's perspective, I mean, I guess the advantage, like why would a bank participate in this versus just trying to do traditional underwriting for their clients? Like what, why would a bank want to participate in this specifically?
So we actually, oddly enough, we actually had that specific conversation at our director's loan committee yesterday, because I went through this presentation with them as well. And at the end of the day, the answer is, if we can get comfortable with it traditionally, then the answer is we're going to. We're not going to use this program because not only, do the economics not make as much sense for us, we would prefer, if it's a good loan, to hold 100% of that loan rather than just 5%. But what I think it's going to allow us to do, and what we've discussed, is it is going to allow us to extend credit in industries and to companies that are candidly not traditionally bankable, but we have a high degree of confidence because of the skill of the managerial team, the market in which they serve, their business model. Historically, maybe they've been a very strong company for 20-year history, but they just hit a really rough patch like many people did. This will allow us, in some cases, to pick up that new client that we wouldn't be able to do if circumstances were good, because their bank would never let them go. And so, as I said, I mean, Jeff's a good friend of mine, and I know works for a competitor. I mean, there's no doubt that I would say he's looking at individual companies at other banks who may not be able to really get this refinanced debt at that institution, and he may be calling on them. As long as he's not calling on my clients, I'm fine with that.
Trying to see if anyone else has any questions. I don't see any other questions down below. But as far as like timeline, so let's say somebody's interested in applying for this. I'm assuming it's kind of like you have 3 years of tax returns, 3 years of financials, personal financial statement for the owner, majority owner. Trying to think, just kind of a basic loan packet, I'm assuming.
Yeah, I mean, the loan packages, I would assume, are not going to be terribly different. I mean, the only thing, as I alluded to, that you may see more requests for than normal would be, what are your kind of forward-looking projections and thoughts? Now, whether or not they're going to ask you to put forward a true 5-year model with, income statement month to month, or if they're going to ask you to look at something more on an annualized basis. But I anticipate for the bank's protection, they're going to want to have some form of documentation of a pretty lengthy conversation and understanding of, hey, explain to me why you're going to get out of this. You know, what's going to change fundamentally in the market that's going to allow you to normalize? And if that needs to be done in financial statements or in a more narrative fashion, I anticipate that they should be having that type of conversation with each and every one of the applicants.
And then from like a forecast perspective, you said you're not really sure what that requirement's going to be. Like, it sounds like you're going to have some kind of financial forecast for the next 5 years, more than likely.
So it's interesting, and I'm going to go down to there's a regulatory, supervisory model that the banks are required to follow as far as FDIC reviews, and it basically referenced a specific form of supervisory that they said it's basically guidelines in the emergency situation and underwriting expectations. So they created these guidelines after Katrina and how banks were supposed to react in a community that was ravaged by a tornado, because obviously you can't go back and ask those institutions and affected businesses to perform like they were before whatever disaster occurred. So what it basically says is kind of, as I indicated, Shannon, it's saying you're not required to put forward financials, but if the bank has not documented a very specific conversation about how the client or the business is going to recover, what their timeline is, and put that in the loan package, that's where the banks then risk some regulatory slaps on the wrist. So as I said, I think each bank will approach that a little differently depending on the circumstances.
Okay, that makes sense. Did have one question about, can loan proceeds be used to buy out an existing shareholder? Or what restrictions are there on the loan proceeds specifically?
Yeah, so again, as I said, if it's a shareholder issue, Ed, I think the question would be is what's the amount of that, and how is that shareholder basically, is it an equity position or is it a loan facility? Because if you're using the new program and that shareholder, for example, did a note to shareholder, right? And you listed it on your accounting statements as a note, then you couldn't use a new loan facility to pay that because you can't use those proceeds to restructure your debt. But if you use the priority loan program and it was listed currently in 2019 as a debt, I don't see why you could not use it to refinance that debt. The fact that the debt's to a shareholder is irrelevant.
But if it was an equity position that you're wanting to buy out an equity position, then you probably have to look at like what their basis is and what's considered income to them for the value of their shares. So making sure it follows that 400, 2 million, whatever those rules are, right?
Yeah, 450,000 to 300 to 3 million. So I think the question would be exactly that: is are you buying them out in full? Is it considered an annualized event? And so you just want to be cognizant of that. I think that would really, dictate how you would react it. But to be truthful, that is still providing, more flexibility than I think, than any other program that we've seen. So I think you probably have some flexibility there, Ed. But there's some FAQs specifically around it because it also depends on your structure. If you're an LLC, an S Corp, et cetera, there's some flexibility and some guidelines there as well.
That's something we could help look at too, because I think I'm sure that the tax stuff comes into play there and like what their basis is and what's going to be considered income to them. Correct. Probably. So we could potentially help look at that, but that's a good question. But it sounded like if you're wanting to use the loan for any form of restructuring, buyout, or anything that's not just a straight loan, you really don't want to do the new in general.
Correct. Yeah.
So you're automatically into that next threshold.
Correct. And I would say, and I'll just give you an example of something to think about. And Shannon, I would want your advice and guidance on this as well, because we've had the question, we don't know the answer yet. So, let's suggest that you have $5 million of cash today. Let's suggest that you have $3 million of debt today. Well, if you don't qualify or don't want to use a priority loan program, what's preventing a company from liquidating that cash, paying off their debt before taking the Main Street loan program, the new program, then taking out a new loan program for $3 million and staying at their current institution? Right? You're just converting. And we know that maybe not in the spirit of the legislation.
Yeah.
But technically, it seems like it could be possible. And so we're just not
It sounds
sure.
like it would be possible. I mean, if you liquidated it and then did it, I think the assumption probably is most people don't have the cash to pay off all their debt, or they wouldn't have it. But I mean, there probably are a few businesses in that position, but it sounds like a loophole.
It is. And so I think the point being is, and I only bring it up as an example, is I think there's going to be many types of very customized situations that both the lender and the borrower are basically going to need to navigate together with the help of a good CPA and a lawyer, most likely. And so it is going to be a little different than the PPP in that regard, because we're not ever going to be able to get all the answers and FAQs before we proceed.
Yeah, it almost seems like it wouldn't be worth it to do that.
Again, I just, as an example of some of the.
No, it's a good example. I was just thinking from a client, like some of the clients, they're pretty tied to their existing bank, for example, and then a lot of people have extra cash now because of the PPP loan. So it's like, in theory, they could pay it off and then try to restructure it. I just feel like the spirit of the rules is not to do that, and so I would just, for our clients, I think we would advise them probably not to do it. I feel like if there's some kind of mental gymnastics to make it happen, it's probably wise not to do it.
But I do want to bring, you brought up a good point, and I just wanted to clarify, because I don't know if this was stated at the very beginning, but it's come up a couple times with some clients of ours. People have asked, if we received a PPP loan or an EIDL loan, are you still eligible for the Main Street loan program? And the answer was very clear. Absolutely, yes, you are. Now, what we asked, and I just wanted to clarify this, is how do we factor in the quote unquote loan, because the PPP officially is a loan, granted potentially forgivable, into the calculation of leverage, because you can lever up 6 times EBITDA total debt, but should you or should you not include that PPP loan or EIDL loan into that calculation of leverage? And so we were given instruction that EIDL, for those of you who are familiar with it and have it, is an actual 30-year loan program. So you would take that balance and put it into that number. But the PPP, because it's a short-term and potentially forgivable, and they have said that you should not. So a little more confusing.
So the adjustable rate today, I'm trying to look. So LIBOR plus 300 today is an example, and it's a 1 or 3 month. What would that be today? Because I don't have the LIBOR rates in front of me.
And again, I'm estimating. I don't know, but I want to say we looked at roughly about a quarter of a point. So you're looking at a 3.25% loan with up to potentially 2% fees. So you have to just factor that in as well, right? And I mean, those can be taken out of the proceeds, of course, but not, many of your clients probably don't have a lot of loans they've done with 2% fees. And we just need to make sure you factor that in.
A $2 million loan, for example, you have $40,000 of origination. And
Correct.
So you would have to, but also, I mean, a lot of people don't have 3.25 roughly rate on their existing debt, or like a revolver is probably higher than that. So you would almost have to, evaluate, is it worth paying the 40 up front to defer payments on principal for 2 years, which cash flow wise, if you look at a return on capital, it still might be worth it. So I don't know, there would be some analysis to do there, because the origination fee, if it's a smaller loan, isn't going to feel quite as painful. But if you're getting a bigger loan to restructure some debt, like those upfront fees are going to be significant.
Well, and just remember, I mean, the program is going to have so many. It's going to have such a huge diversity of participants, because depending on the program you chose, it can start at 250,000 up to 300 million. So if you think about a company that can lever up to $300 million, it's going to be a very large middle market, almost mini corporate in many cases. So it's going to be very interesting to see how this all plays out. And not to mention the fact that, and we just don't know what participation is going to look like. It does have a finite amount. So we could
75 billion or something like that?
Yeah, about 75 billion. So I know it sounds crazy, but a few $150 million loans, and that starts to dwindle pretty quickly.
Yeah, I think my guess is it's going to be a lot of smaller loans, but but we do have a lot of clients. I think for us specifically, we're looking at just how their existing debt is structured, and for a lot of them to be able to defer principal for 2 years from a cash flow perspective, and then also to be able to consolidate debt at a low interest rate, even if you are paying that origination fee. That rate's just so much lower than like traditional business loans that most people have in their books right now. So that's kind of what we're looking at, is going through our client list and figuring out, who has debt, what rates it at, does it make sense to try to consolidate it, and that kind of thing.
Sure.
So that's kind of at least what we're looking at. And then in general, just for everybody on the phone, I think that it makes sense to spend some time just analyzing what your current rates are and your cash flow, and at least for the next 2 or 3 years, you could almost get it in place and then reevaluate and try to restructure. Where I think you're, need to be careful is, like Alan said, not to over leverage and then find yourself 3 or 4 years down the road where you're not bankable because you have too much debt and you can't restructure it. And then you're not prepared for 70%, basically to pay it all back at once. So it needs to be managed really carefully. And I would almost set aside funds as if you were paying it on a regular amortization schedule, or try to, even though it can sit in your bank account almost like a savings. But if it dwindles down and it all comes due year 5, that's going to be painful. And a lot of banks probably, like Alan said, you might be over leveraged to refinance at that point. So does anyone else have any questions? So next steps, like if someone were interested in this, for example, let's say they pulled together kind of a packet and they wanted to meet with you, like what's the turnaround time? What does that process look like?
So, I mean, again, just to be fair, I think every bank's going to be different, obviously, and so I think it just depends on their process. But from a community bank perspective, and again, I'll kind of speak generally for us. Most community banks have some sort of loan committee structure that is meeting on a fairly regular basis, and my understanding is most have maintained that schedule. So, for us, we meet our officer loan committee weekly. And so what we've basically determined is, given the fact that we're going to be holding at most 5% of these loans, the vast majority of our decisioning can be done basically in our weekly officer loan committee. So what our process would be is you would submit your loan package. Typical turnaround for us is about a week to 2 weeks of just kind of putting that package together, of getting the spreads, having the conversation about what the next 5 years looks like, understanding the business, making sure we've done all of our due diligence, and then taking it to that officer loan committee. And again, because that hold is only 5%, almost everyone that we're considering looking at, we feel is going to be well below that. I mean, we're just not doing $100 million loans. I'd like to, if you guys have any, we'll happy to take a look at them, but.
Well, and it's based on, you said 2019 EBITDA?
And it's very clear that it says 2019. So the calculation says you take your 2019 traditionally tabulated EBITDA. So if you had, for example, a lot of add backs, one-time exceptions into your 2019s, the bank is being told that it should adjust that number in 2019 to its standard EBITDA that it would use over multiple years. Okay, so, and again,
So you would normalize, you would have to normalize your financial statements for
no, you wouldn't have to,
things like that.
Yeah, you wouldn't have to normalize it. It's just that the bank's going to be told to justify if there's a bunch of add backs that the Federal Reserve could not see in 18 and 17, right? They're going to say, well, why did you accept it in 19 if you didn't accept it in 18? And so there needs to be some by the bank. The bank's going to have to justify that use, assuming that you're utilizing the full leverage, right, up to 4 or 6 times. If you're doing less than that, it's not really an issue. It's only if you're maxing out the eligibility requirements. So you take that.
So what if a business had a loss in 19? They just would automatically not qualify?
Unfortunately.
Okay.
Yeah, you have to be basically a sustainable 2019 company and then show February on that dive. Yeah, that's absolutely, so that's going to be a challenge for some companies, of course.
Well, we have some smaller business owners too. I was thinking, they don't necessarily depreciate equipment and things. They, expense things straight through. And so I think that there would be a, accounting exercise to go back and make sure that the financials are, are GAAP and that,
Yeah, so you bring up a good point. So they have to be GAAP. Now they don't have to be reviewed. They don't have to even be CPA compiled. Okay, but they do need to be GAAP compliant. And if the EBITDA number is not reflected on the current financials, but they are GAAP compliant because you just don't use EBITDA in the presentation. I mean, as long as it's GAAP compliant and the bank can take your net income, add back amortization, tax depreciation, they can do that on their own and come up with the EBITDA number. They're not requiring that the financials show EBITDA. Okay, just that calculation that is used to determine it is GAAP compliant and is something that is standardized over multiple years. So if there's one-time add backs, et cetera, if you were going through a merger acquisition and you had huge costs that you did in 19 but didn't show in 17 or 18, there needs to be some adjustments there. But again, that's really going to be relying on your lender to work that, add it back and document it. And so again, with that, just remember that it's 4 times the total leverage, meaning your EBITDA in 2019 offset against the current amount of the Main Street program or loan, plus all other debts that are not being refinanced. So if you're taking a $4 million refinance and $2 million of new money, that's $6 million. So you have to use that against your $1 million of EBITDA, that would qualify. Inversely, if you had $500,000 of EBITDA, and you were using the priority loan program, you could only go up to $3 million of a total loan, and that has to be all the loans combined. So if you're not refinancing debt and you're using the new program, it's the combination of all your available existing debt plus the new debt under Main Street.
Thank you. That's helpful.
Yep.
Well, I want to be respectful of everyone's time. I know it's almost 10, so I don't see any other questions, but if anyone has questions or comments, I'll stay for a couple minutes and I'll put my email in the comments. And so if anybody wants to either email me a question or follow up after this, we can do that. And thank you, Alan, for your time. We really appreciate it. It was very helpful. And we'll do this probably again to revisit some of the PPP new guidance in about a week or so. So be looking for that.
Thanks, Shannon.
Thank you, everyone. Have a great day.
Bye-bye.
Thank you.
Thank you, Amanda.
No problem. I'll send you the recording link once it's done.
Sure. Want to make sure, Keith, I have it on my to-do list to call you today. You're on mute. I don't know if you can hear me. Keith, are you still there?
I clicked the button to ask him to unmute, but
Yeah, he might have stepped away. I was, I have on my to-do list to call him because Crystal was like, we owe him a phone call, and she has the meeting all day today. So, well, thank you, everyone. I think everyone pretty much logged off then. So, yeah, send me the recording and I will send it out. Thank you.
Sounds good. Thank you.
Bye.